Hello, welcome back. One of our subscribers suggested that we take a look at Rowe Price Group. T actually stands for Thomas, in case you were not aware. I wasn't, I had to look it up actually. So it's Thomas Rowe Price Group. This is a pretty well known publicly owned investment manager. One of my old employees, I'm actually not working for anybody right now, but when I was, I had actually a 401k, and I still have it actually, in Rowe Price Group. So they are a very, very well known investment manager. I knew about the company. And I think it's very interesting to take a look at. I haven't actually examined the company before, and I was actually intrigued by this suggestion. So after I took a while at it, I was pleasantly surprised, and in this video I will actually explain what I discovered about the company. Now, this one is not a trendy target, of course, and I kind of like this because these kinds of companies tend to go unnoticed, and this is when you can accumulate more of those and actually make the most money throughout the years. So you will see that it has been, growing a little bit lately, but if we take a look at the 6 month period, it's actually down from December, oh, no, that's actually September 2021. And in the last 5 years, you see a bigger line here, which goes back to 2017. You will see that the company has been increasing its value and has a little bit of a slump here, which can potentially give us an interesting entry point. So I like to see that. It's about 31% down from the recent high over here. Here probably it was. Yep. Yep. Okay. So what about the company's financials? The P ratio is sitting at 11.7, which is looking good. And it's actually one of the lowest ones that they had in the last 5 years. Same with the price to free cash flow ratio, encouraging signs. And also outstanding shares keep decreasing. All of these signs are good, and I like to see those for the companies that I acquire. And 60% revenue growth. This is obviously a large company, and you can't expect to have an insane revenue growth, but still that's pretty good. And net income growth of 105%. That's even better. And the free cash flow growth increase is insane here. They're becoming more and more profitable, so that's nice to see. And they're accumulating free cash flow. We will examine that a little bit later in detail. And they're making awesome net income margins here. You would kind of expect that because they're making tons of money from fees and all that, and it's about management pretty much. Fun fact: you probably never really need a manager for your money. So hopefully this channel, this YouTube channel, can actually help you with that because you really don't need to be paying management fees. Uh, so the price to book ratio is a little bit elevated, but that's fine. That's totally fine. And they're paying a 4.8 dividend yield. That's a very hefty one. They have a 54% payout ratio. Now, typically, this will give you an X if it's more than 50%, but 54.3 I think is sustainable for a while. Now, this has to be a little bit careful here. You have to be a little bit careful here about this one. But this kind of dividend yield is very, very hefty. 5%, that's a lot. So, you have to bear in mind that they still need to be able to, to pay this out. Their net income seems to be increasing and increasing nicely. But in case they have some sort of slump, this can be in a little bit of danger. Right now, I think it's probably okay, but bear that in mind if you are, if you are taking a look at the company. This can be a little bit of a danger because if they slash the dividend, the company stock price will go down. So that is something to take care of, be cautious about. So the next thing that I'm going to do here, I will take a look at the income statement of the company. I want to see what kind of revenue growth they're having here and how they're doing with their net income comparably. So from 4.7 to 7.6 here. That's good to see they're increasing, as we already saw it pretty much. But the net income, yeah, also keeps increasing very nicely. They have about similar growth rates, which is also another good thing to see. Nothing suspicious here, nothing weird. Everything looks fine, really. What about the balance sheet? They should be increasing their balance sheet nicely, and we will see their liabilities and assets. We can always discover what is happening exactly. But what I want to see is the totals, which is total liabilities of 2.2 billion. That's not a lot. And total assets of 12.5. So they have a total equity of 10 billion. That's pretty good, actually. Keeps increasing nicely over the years. What about the cash flow statement? The cash flow statement here is showing positive operating activities and increasing operating activities for the most part. 2021 has been a great year for them, it looks like. And cash from investing activities, also great. They're spending money in investments, some other investing activities here, and purchases of investments, pretty much investing a little bit. That's nice to see. And of course, the capital expenditures, typical investments here. I'm very interested in this part here. So they're repurchasing some stock as we already have seen, and their financing activities are negative. So it means that they are paying back debt and paying dividends as well. So their biggest expense in terms of financing, of course, is the dividends. Yet they are still buying back some shares. So that's encouraging because they keep on doing it every year, pretty much. And I suspect that they think their stock is cheap, and that could actually be the case. It looks like it is the case actually, and that's actually fairly nice to see here. The fact that they are actually buying back shares, because if you buy shares now, then you are likely to get to get a little bit of a premium just because less shares are going to be in the market in the future. Seems like they have a little bit of a pattern here going on. And the free cash flow for the company also keeps increasing, and again this increases nicely here. So the free cash flow of the company is increasing nicely. I kind of want to quickly take a look at the depreciation, amortization, stock-based compensation, which they are added back because they are non-cash items. Now that's not weird. I mean, these are kind of expected. There is a non-cash item here that was added back to the free cash flow, so you may want to exclude that. I'm assuming this is a one-time thing. So technically speaking, they're probably sitting at 3 billion in terms of its actual free cash flow. But okay, I mean these are actually included in the income statement. They are just added back here as a non-cash item. This is why they are added to the free cash flow. But just to to verify how the company is doing actually with their free cash flow, it's good to notice these things. It's increasing though, and it's increasing very nicely. I mean, from 2020, this is a steep increase. So I like to see that. And so far, I'm almost sold about the company, but I'm gonna take a look at the most important part, which is determining how much the company is worth. Because it may be a great company, it may be doing well financially, and it looks like that's the case, but we want to make sure that we're getting it at a decent value. That's very, very important, because at the end, we want to be making money as well. So based on the revenues, and this is another great thing to see here. I like the companies that do that. These are very, very close to each other. You are noticing consistency here for the most part. So this is a good thing to see. Very, very good thing to see. And when there is the odd one out, the year that is weird and different than others, it's always better to be weird on the upside, of course. So the revenue growth that we're going to go with, the company had a 5% in 1 year, but typically they have like 10%, 12%, 13, 23 here. So I think I'm going to go with 10, 12, and 14 here. I think that makes a lot of sense. Oops, let's go 14. And the net income margin is fairly similar. It's almost always the same. Again, this is great to see. Very, very good to see. So I'm going to go 36, 38, and 40, basically what they're doing. And the free cash flow margin, again, is very similar with the exception of 1 year here and last year, which was amazing. But I'm going to go 60, 70, and 80 because we want to be kind of conservative. And for the annual return, I'm going to go 13, 13, and 13. Because I want to be making 13%, right? I mean, more than a casual S&P 500 ETF, which is about 10% a year. So if we hit calculate now, we will notice that even at our lowest estimates here, which we are red, we're very, very close to the current price. And the medium ones and high ones are actually above our current price. Meaning that for these two estimates, we're well within our limits of buying the stock today. And even the low ones, we're still very, very close. So in terms of this company, I like it a lot. I mean, everything I'm seeing so far looks pretty good. And even for the low estimates, again, we are very, very close to the current price. So a company pays a hefty dividend as well, and a 54% dividend payout ratio, which we examined a little bit earlier, is probably the only thing that may be slightly concerning in case there are some years in the future that are going to be weird and the company is not going to be making tons of money. That could be the only concern that I could potentially have, just because the company may not be able to afford this and has to slash the dividends. although they don't have a lot of equity. That's a lot of debt. Sorry, that's another good thing to see. So debt to equity ratio, you see, it's low. So it means that they have less debt compared to equity. So for every dollar of equity, they have 25 cents of debt, which is good to see because even if there is a slump in revenue and profit, they could be using some of its equity, some of their equity, or get more debt basically to pay to sustain the dividend for a while, even if things go wrong. That is, of course, you don't want that, but it's probably sustainable, I would say, for the next decade, unless something weird happens with the economy, unless there's some sort of insane crash or something of that sort. But other than that, I like what I'm seeing here. I like this company, and I may actually even think of adding it to my portfolio. I mean, seems like it's a fairly good one and a very nice catch. It's not easy to find these kinds of good companies these days, and thanks for bringing this to my attention. I had a lot of fun analyzing this, and again, it looks very interesting. I may eventually even add it to one of my compilations. This looks very good. Thanks again. So hopefully you enjoyed the video and it gave you some ideas about Thomas Rowe Price. And if you did enjoy and if you like these kinds of videos, please leave a like. That really helps the channel. And also subscribe if you're not a subscriber, because I'm making tons of content pretty much every day, a lot of videos. And so you may want to stick around, because eventually I will also be giving you access to this tool and you will be able to do your own projections whenever you want them for any stock. And in the meantime, take a look at this video that I made earlier. And it discusses 5 stocks that I feel are undervalued right now. And I think it's a very, very interesting watch. So thank you for watching this one. And hopefully you will enjoy the continuation of your viewership with another video. Again, thanks for watching, guys. And I'll see you soon. Bye-bye.